Not a boring show today, Ben. All oil all day. But
Interesting. The oil's down below 60, down about 30 cents, but all the energy stocks are pretty much all they're doing are in the green in a down market. Maybe a little rotation here.
we're due for that too, Bob.
We've been due. I mean, they've held a lot of these better names have held in. They're just not up, like all the Mag 7 or Mag 9 or whatever you want to call it.
Or the AI growth bubble stocks.
Yep.
They're pitching Cummins engine as a data center play now, even though the heavy duty truck business is imploding. They make, backup generators. They make backup generators for data centers. Okay.
No, you can replace all those illegal immigrant drivers in California with automated trucks drivers.
Ben takes Waymo every day.
Exactly. Was Trump on TV the other day saying we're going to see gasoline prices below $2 soon? Wasn't he saying that?
I don't know.
He's
what happened?
Certainly.
What happened?
This energy tape is played into his favor.
He can't force the U.S. companies to overproduce, but he can force the Saudis to overproduce.
Yeah. Well, they're going to pause here in the first quarter, but this government shutdown with reducing flights and all this is beginning to make a little nick into the demand side of things, too.
China's been taking 1 million barrels a day, right? 1% of supply for their strategic reserve. If that stops, the oil market isn't going to be fun.
Yeah, but I think they continue that through 26. So, but you're right. That's what's been propping up the oil market. If it weren't for that, oil would probably be in the low 50s.
Yep.
Are we live here, Jen? Or are we just chatting away? Or
1 second.
Energy Transfer made an interesting announcement. They signed a 1 billion cubic feet a day contract with Oracle for data centers. So the market's what, 110? It's almost 1% of the U.S. market.
Yeah, but what was the pricing on it? What was the price index on it?
I have no idea how. They're just delivering it. They're the pipelines. They're not the producer. I don't know how it's priced. I was just surprised at the volume.
Man, what an interesting morning.
Looks like the government shutdown's going to last another week here. The Democrats are emboldened by all their wins.
So Robert, we did one other interesting trade. We shorted, or we bought not the 90 puts on the EWY the day it hit 100, which is the South Korean market, the Kospi, and that's now 94. So the whole market's down 6% in 2 days.
That's pretty good.
There seems to be the general theme. I think what's going on is we're in a deleveraging right now, and you can kind of tell there's no gas. Like just some of these earnings, right? Like Live Nation. I mean, AMD was okay. Like, there's just no bid for these prints. So while they're like, okay, yeah, they're in line, I think what it's telling you is that for a lot of this stuff, the market is not based on cash flows. Let's put it that way. It needs that leverage machine in order to maintain these prices. Now, I don't know if in Bob's world that's true at all. So we're going to talk about, some stuff that's out of favor and is actually valued on cash flows today. You guys ready to go? Should we get this show on the road?
Ready to rock and roll.
Yep.
All right. I am Benjamin Brey. This is Bob Morris and Robert Marcin. This is Wall Street Beats. And we are coming at you on November 6th. It is almost Thanksgiving, amazingly. All right, so let's get it going. Bob, let's kick it off here. Let's talk about some businesses that are still valued on cash flow. What do you got for us today? And the energy
Yeah,
bash.
when you mention cash flow and valuation, the energy sector, hands down, has the best free cash flow yield on valuation of any sector in the market. But it's a commodity market, so you're always facing that concern or headwind. But what we got last night and this morning is another handful of results, and these companies continue to beat across the board, and it's continued to be driven by largely the capital efficiency gains and the improvements in the operations and the cost structure of all of these companies. And this is, I don't know how many quarters in a row, pretty much across the board beats. But we saw it last night. This morning on CNQ, it's down slightly, but they beat across the board. Apache in particular beat across the board. Devon beat. Conoco sort of still digging through their 2026 guidance. But this industry, if you look across all the sectors, I know a lot of the broader market has beat so far in the quarter, but energy consistently has put up another quarter of beats across the board, again, driven by these capital efficiency gains and improvements. And I think one thing that's notable is they expect these to continue, particularly from the side of AI. AI is a big factor for energy. The amount of data, the amount of horsepower and computing power that's put into drilling these wells and picking these locations is huge. So this is an industry also that should be a big beneficiary of AI. And so as we look at things, the headwind, even though everything's up this morning, is oil prices here continuing to be down around $60 a barrel, a little bit below $60 a barrel today. As Robert and I were talking ahead of the show, part of what's been supporting it to some degree is China's continuing to build their strategic petroleum reserve, adding about 1 million barrels or more a day. I think that continues into 2026. We mentioned on Monday that OPEC is going to take a pause in the first quarter of next year of these production increases. They've been putting more oil into the market. And I think this government shutdown is starting to eat in a little bit here to demand. I saw a statistic yesterday that the government shutdown could take 2 percentage points off of GDP in the fourth quarter. So as you look at airline cutting back flights or schedules and what's going on as a result of the shutdown, it is beginning to impact the demand side for crude oil or crude oil products, gasoline and diesel fuel, jet fuel in particular. So that's been the headwind. But regardless, energy valuation-wise, I still think looks very attractive. The natural gas names have, in particular, been on fire the past week or 2 weeks. Expand Energy, when we were talking about it 2 weeks ago, is up more than 10%. So the natural gas names continue to do well here. Now we're into the winter, and we'll see how weather plays out and demand side of the equation for natural gas plays out through the winter, depending on how the weather is. But on the oil side, the concern or pause is on the oil price. I still think there's limited downside from here, that will still be largely in this range of $60 to $70 a barrel. And on that basis, I think the stocks are cheap. As far as the earnings, C&Q has been one of our favorite names. They reported good results this morning, bumped up their full year guidance, as did several companies here, just again on production beats and the better operating performance here. So we continue to like that name. I think Apache in particular was the big outperformer on the quarter, bumping up their guidance on production, bumping down their guidance on costs. Devon had a very good quarter, and who was the other one? EOG reports tonight, but then ConocoPhillips was so-so quarter, but a beat, but moving more on the 2026 guidance. So, we're not changing our view on anything here. We've placed more of our bets on the natural gas side, given I think there's more certainty or less uncertainty around the price here near term on natural gas than there is on crude oil. But that's sort of where we are here.
Yeah, I mean, I just think that it's your dynamic. I mean, where do you see the production right now? Do you see production going down in the U.S.? Do you think where do you think production will be in 2 years? I know nat gas follows because it's a waste product for oil, but so when you just think about the drivers, oil, where do you think U.S. production will be in next year or the year after that?
I think it slowly creeps up. The fact is, you've got a lot of these companies saying, "Oh, we're going to run a maintenance program. We're going to keep production flat." But even Chevron last week said in the Permian they were going to keep production flat at 1 million barrels a day. They're slightly above that, just because they're doing more with less. So the well performance is better. They're drilling wells faster. The completion technology is continuing to improve. So what happens here is they follow through on their spending plans or their activity plans, but they're squeezing a little bit more out because of that. And nobody's planning on letting production drop. And even if you look at, say, the small private companies and such, they're not looking at letting production drop. So U.S. oil production is going to stay flat to probably more likely continue to creep up just slightly here going forward. It's interesting on the natural gas side, while a lot of companies are running a maintenance program or saying they're going to keep production flat on natural gas, most of them say we've got the ability to quickly dial it up if demand's there. So they're all sitting there saying, well, we're going to get this increase in demand from AI data centers. We're going to get this increase in demand from LNG, and we can very, very quickly increase production, either from curtailments they have today or drilled but uncompleted wells in inventory they're waiting to complete, to turn on. They could very easily, if natural gas, everybody said it's going to be $4 to $5 here for a long time, you would see U.S. natural gas production increase or tick up very quickly. They have that ability to do that. They're just waiting for the price signal.
Okay.
I believe production year on year is up 4 or 5%. So demand has been solid, and they've met the demand. And as you say, they can meet even more demand. That's why it's hard for these knuckleheads to let the price stay above $4. Because once it gets above $4, they start turning open the spigots again. So turning the valves open.
And we saw that to some degree last quarter. Some of these companies in the quarter when the price ticked up, and some of this is driven by the regional basis price in, say, the Northeast and such, but some of them did turn some of that production back up or back on. And that's why you're right, Robert, unless we see the significant increase in demand, is every time we hit a 4 handle or above, you're going to see a little tick up in the gas production. They're going to turn a little bit more, put a little bit more in the market, but because they get very good returns on that and have very good margins at $4. So,
yeah, they say so, yet none of the stocks have done well. So I think that's full of poop too, by the way. But you and I can talk about what a sustainable gas price is for a shareholder EVA, okay? We'll talk about it. It's the wellhead returns that they talk about. Oh, 50, 80% of it at the wellhead. The world doesn't buy gas at the wellhead. The wellhead doesn't have royalties in it, taxes, overhead, interest expense, depletion. So that's bullshit when they say, oh, we're getting these high returns at $4. We've had $4 on average for a bunch of years, and the natural gas stocks are where they were 4 years ago. So I don't think that. I think management tells us the returns are great above $4, but they're not. History shows they're for the stock.
You have to look at the total corporate ROE for these.
Yes. Names. Yep. Totally.
Yeah. Let me ask you. Speaking of gas, I was actually digging around, pulling. Bob, we're getting close. I'm starting to look at E&P names again, and even small mid-cap ones. Have you looked at Comstock at all recently? The Haynesville gas play?
I knew that's where you were going, and that's the name that Bates talked about, that the chart looks great on. The thing is, with a name like that, he mentioned
that's great. The chart looks good, too. I love it.
Yeah, he mentioned yesterday that perhaps I don't like the balance sheet, but the balance sheet gives you more leverage when the gas price is going up. Because
no kidding, of course.
When you got a company like Comstock that has smaller margins, that dollar increase in the gas price is a bigger percentage on the bottom line. So in a rising natural gas price environment, that balance sheet gives you a lot of leverage to improve results, and that's why that chart looks so good.
Well, that's 100% what I'm saying, is that if you're going to play a commodity move based on an E&P company, you want some juice. When you buy EOG, you're not getting the juice, right? You want to buy California Resources or Danbury, or I'm trying to think back in the day, the ones that had the most beta to the oil price. But Comstock has some juice to the nat gas price.
Yeah, when gas is at $2.50, they look in trouble. They don't look
got
good.
Some juice to the downside.
but when gas goes to $4 and people start raising their estimates, that's the name where the estimates ratchet up the most.
Yeah. I mean, do you have any view on I know that they have a little bit of a distribution challenge being in the Haynesville versus some other ones. Do you do anything fundamentally about it other than, the fact that it has some juice to the upside versus gas?
I mean, the juice to the upside in the Haynesville, that's where Expand Energy is. And they tout the relative closeness to the Gulf Coast for LNG exports. And once that Comstock's able to tap that, they're in a good geographic location to take advantage of all this LNG export build out, and in a good margin area where, there are good margins in the Haynesville. That's, you continue to see improvements in technology and such there too, even though some of their competitors will downplay the Haynesville and where the break evens are and such and so forth. But still, again, that's the juice that you get, the leverage you get to the rising gas price for that name. So yeah, in that environment, and that is the name that Jerry Jones made a big investment in, and he's up big on his investment.
You beat me to it. You beat me to it. I was going to say, you can join along with the great Jerry Jones in that one.
He's already up huge in that investment. I think
Look,
he's up
Jerry Jones hasn't been a great owner for a while, but he has definitely been a good oil and gas guy over his career.
Yep. Yeah, and he's up over $100 million on an investment.
Pretty good. I mean, well, in today's world, that's nothing. These guys talk about trillions and hundreds of billions and stuff. That's just more pedestrian, old world stuff, but pretty good for us normal guys.
Exactly.
All right, you got anything else, or let's move to Robert?
No, it's more of the same. This is more about the oil business. Sorry, guys, because I do owe our viewers, to the extent that subscribers, to the extent that they partake of the stuff that I trade in, and updates on the businesses. And today is MLP update day, because in the last week, 4 of my big MLP positions have reported. MPLX, which is the Marathon Midstream Spinout, Energy Transfer, Enterprise Products, and Plains All American. So I could just say it was a big snooze fest on the earnings and EBITDA releases. In general, the fundamentals were at or slightly below the low end of the range from operations. There wasn't a lot of pricing in the commodity markets for these guys to exploit. So with oil and natural gas prices declining, more importantly, propane prices are down at the low end of the range. It didn't have a particularly good 6 months year-to-date period. So a couple of those guys have big exposure to natural gas liquids, and for them it's more propane than anything, I believe. So it's, the stocks have been, flat to down a little this year. The dividends are fine; they're growing. There's an interesting breakdown in the dividends. The 2 oily MLPs that I own, MPLX and PAA, today yield 8 to 9% and are growing their distributions double digits. So if you want to buy a 10% yield on next year's earnings, you could buy Plains All American today at an actual 10% yield when they raise the dividend. It's $1.52 going to $1.67, and the stock is 16 and change. So 10% yields are hard to come by with solid coverage ratios. Real 10% dividend yields today. The natural gas guys have more of a story and are investing more for growth. So Energy Transfer and Enterprise Products have 7.5 to 8.5% yields and grow them 3 to 4% because they're investing more heavily in growth. So I own them all.
What did you think of ET's print last night?
It was a little light. It was well telegraphed. Yeah. The stock's not down, and they talked up some of their opportunities to deliver gas into the data center boom that's happening in Texas, and they say they're the best positioned pipeline to do that. So, we'll see growth resume in these companies in 2026. But it's a capital intensive business, and growth projects take 2, 3, 4 years to develop. And, none of these guys were investing heavily for growth 2, 3, 4 years ago to deliver it today. They were still in the throes of the, post-COVID oil crash and repairing balance sheets and being very disciplined, that kind of stuff. So the C Corps generally yield 3.5 to 4.5, maybe 5%. I happen to believe the MLPs are far superior if you're looking for income. They have lower EBITDA multiples at 8 to 9 to maybe 10, whereas the C corporations trade at 12, 13, 14 times EV to EBITDA in the pipeline business. And, I don't think natural gas has has delivered the unit growth it's going to deliver yet in the next 2 to 3 years from both LNG booming and the electricity production for data centers. So I believe the unit demand story is going to be very strong for the next 3 years. As we were talking prior to the show, however, there's an infinite supply of natural gas above $4. So I doubt it will, go above four and stay above four. So if it pops to 5 or 6, it's best to hedge it out. For these natural gas companies to hedge out if they can get those prices. If there's a real cold snap and we have a cold winter and the strip were to go up into the 4 to 5 range, I would probably hedge out gas production if I were a CEO of a natural gas company, because there's just too much supply to let this commodity participate in commodity moves that happen to copper or gold or lead or tin or whatever's out there trading up, in the commodity markets.
Hey, Robert, can I ask you a question on an MLPX with a 10% dividend? Every time I see a company with a 10% dividend, I worry that the market's telling me something that dividend's at risk, which I know in MPLX you think it's not at risk. But what is the market worried about? What is the risk that they're willing to price in 10% yield on a stock like that?
I may have misspoke, Bob. Plains has the 10% dividend right now, and Marathon is eight and change, 8 and 4, I think. But it grew 12.5% last quarter, and last year, this year, last quarter they raised it for the year, and they committed to 12.5% for 2 more years. So if you wait long enough, it's 10%, right? It's 840, so it's going to be 9 and change next year and 10 after that. And it has one of the most aggressive growth profiles of any of the oil-heavy companies, because they're investing very heavily in their natural gas chain, from liquids to terminals to LNG processing, everything. Plains is perceived to have very limited growth opportunities, and the payout is only about, I think they took it down from like 1.7 or 1.65, the coverage ratio, down to 1.5, but it's still a 1.5 times coverage ratio. So the leverage is in the mid 3 turns, 3 point. It's at the beginning of the year it was 3.0. They did some deals and they're at like 3 point. They're going to be at 3.4 or 3.5 when they close 2 deals. They have a buy and a sell, and the buy is closed and the sell doesn't close until the first quarter. So they'll be in the 3.4, 3.5 debt to EBITDA ratio, which is the middle of the range for these companies. And a lot of the C corps are much more leveraged than low to mid 3s. So the balance sheet's not a problem. The coverage ratio is not a problem. They had recontracting risk when longer term above market contracts had to roll over. They've addressed them, chewed through them this year. It led to flat EBITDA this year, but they're positioned to grow. I happen to think that's the most exciting one of the 4 I own, because it's also a takeover target. It's very viable by some of the bigger guys, and obviously they would just absorb it into a C corp, structure. So yeah, it's to me, that 10% yield and how they've positioned the company for growth this year after digesting a flat year with EBITDA, I think is positioning them. Plus the chance of taking over is, if I had to buy one of the MLPs, even though it's in the least sexy area with limited natural gas exposure, it would be Plains All American at 16 and change. And I've talked about it a few times, and it's been 16 and 17 and 17 and 16. And I'm banking on 10% a year income. It's not bad on my cost basis 4 years ago. It's probably closer to 16%, 17% today. So it's been a nice holding, and I'll probably hold it forever if just because it's in my income portfolio. But it's safe. It's very safe.
Yeah. I mean, I own the ET. That's steady Eddie. I mean, the other thing about these MLPs, just to round it off, is you can't really sell them. So because as your cost goes down with every distribution,
Yeah.
You have this thing where like it's a penalizing tax bill to get out of them. So you better
The
feel
income,
good about what you own, and if it's steady, as they should be, they're very steady fee-based businesses, but they're not trading stocks. Let's put it that way.
no. But yes, you do lower your basis as you get your distributions, and some investors have large negative basis. So you have
I
to
have I
you
have
have to put that
close
into
to
your
negative
estate.
on ET.
Yeah, yeah, you're paying a big capital gain if you sell these. So.
Incrementally, but more than the 20% you
Right.
gotta go account for that negative basis.
Yeah. Yeah. Yep. So, well,
All right, well,
and I had another energy stock report,
all right,
Select
go.
Water. Select Water, it was in line. It's disappointing because the trend in the EBITDA estimate has been negative all year. But I still like the produced water story a lot. And one of these days, they're going to give us this aha quarter where this produced water pipeline infrastructure business. It's a network in the Permian, and it's going to generate a flywheel effect across their chemical treatment business and their water delivery business. If you take the produced water that's now a major problem in Texas and you treat it to reuse it in fracking, you take a lot of it's just synthetic disposal problem, or you remove it by not having to dispose of it. So these guys really, if they were operating well, should be growing in all three divisions because the recycling part of the produced water business should support them getting contracts for the water delivery and the chemical treatment, and they just have not been able to really make hay with that yet. And they say they're still optimizing their network and selling these package deals. And they did land one large one with a large customer this quarter, but it was the first one for the whole full cycle. And it's a growth company that happens to be in the energy patch that is not growing its EBITDA as much as we had hoped 2 years ago. So the stock's up like 50% for me in 2 years. It's been kind of a disappointment because there was another company I looked at in the same theme when I was buying this at 7. That was 8.5, 9. That was Aris Water, and they sold that for 24, I believe, just last quarter. So I missed a triple and bought a 50%er. I was in the right. I was in the right horse race. I was on the wrong jockey, I guess. So I think there's a lot of catch upside, but it's more energy, and I don't need any more energy in my portfolio. So I own it. It's been fine for a mistake, but it hasn't yet hit the level of growth that I expected it.
You can always have more energy, right, Bob? You can always have more energy in the portfolio. It doesn't have any energy right now is the Bitcoin. That thing looks like it's going to Goblin Town, led by Michael Saylor.
Yeah.
The micro strategy. I pulled that up again, and like, man, that thing is not looking good at all. I think that guy's gonna have to keep selling stock to pay his dividends for the converts and the preferreds, and he just oof. So it's not. I actually saw something funny yesterday. I don't know if I sent it to you, but somebody posted that Dillard's has Dillard's, the department store business, has a better 4-year trailing return than Bitcoin. I was very amused by that. All right, I think that's it. We got anything else, guys? You guys want to talk about, or we'll call it?
No, I'm good.
I'm good.
All right. Well, that's good. All right. Well, enjoy the
Oh
market,
wait,
and
I do have some. Sorry,
all right,
guys.
go.
This is the death chart, and it's a death wish stock. But I moved it from my watch list to my portfolio list, although I haven't bought it yet. But that's the first sign. But I'm getting interested. I have a death wish to lose money in Abercrombie and Fitch. ANF is the chart. 68 and change. It's down from 200 last year. It's up from 25 4 years ago, and it's trading for 3 times EBITDA if the numbers are good, right? 3 times 0.0, and it's trading for 53% EV to sales, 0.53. Do you know what the stock market trades at? 3.53 times sales. So the stock market, so this is 0.53 versus is half of sales in a 3 times sales stock market. Now, there's a lot of questions about the Abercrombie brand. There's a question about the business. But in the end, these things are really businesses. They're not just trading pieces of paper. And I could be early because they had a big boom in margins 2 years ago. They were making 5-6% operating margins. Their goal was 10. They got to 15. I guess they got lucky. And then the margins now have been working their way back to 9, 10, 11 from 15. And the question is 10 sustainable? And I would bet that it is, but that doesn't mean I'm right. But today's levels of earnings, I think the low person on the street is $10 next year. If they made $7 at $68, I think the stock would be cheap. But I believe this could be LBO'd because there's net cash, and there's a lot of private equity firms that need to put capital to work. So these bad retailers get bought out at better than 50% of sales. And Abercrombie, while it's not a bad company, it's the same price stock it was 20 years ago or 25 years ago. It's a decent company. So it's almost getting cheap enough at half of sales for me to hold my nose and stick my hand out and try to catch that falling knife.
I kind of like it a little bit. It's like this was such a hot stock, and now all the hot money players are long gone.
Yeah, they got burned.
Oh, I mean, when I look at this thing, it's got the classic, our partner Jeff Mackey likes to call it the Christmas tree of death. There is this worry that it would go back to like 40, I guess. Like, what would you think the downside is here? Like, go ahead.
If the earnings hold up anywhere near around $9 or $10, it doesn't have any downside. If they make $5, then it can go to 40, right? Again,
so it's an all earnings.
Look, the issue with buying the falling knives is that I did it in Weatherford. I bought too high. I averaged down. I got out. I have a profit now. I've trimmed some stock with a profit because I averaged down, but the earnings estimate went down 30% after I bought it. It had rolled over to flat or down 5%. And I'm thinking, well, if they only go down 5%, the stock, they always get a fair PE. It just is what's the E off of it. So if they go back to making $2.50 or $3, then the stock's going back to $30. I can't imagine that the business would deteriorate that much that quickly. But for a long period of time, they only made $2. So it's the disconnect you have when you go from making $2 to $10. People won't pay for $10 unless they see it for 5 years. So right now the market's wrestling with what's the normalized earnings power. Same thing that happened with Crocs. Okay, they're not great stocks unless and until someone decides to own the business. And there's a lot of companies out there that do takeovers of. You saw Skechers go private this year, right? So there's no reason that this company might not receive a bid from a retail or apparel related LBO shop, in my opinion.
Yeah, I think that's right, and I think public LBOs would be interesting to see them come back. The credit spreads are very narrow, and there's more there. Like one of the reasons that is, especially in high yield land, is there's been more demand for credit than there is, or demand to, put capital to work in credit than there is actual demand to borrow, which kind of tells you something in itself. But last thing, I just wanted to give a little update that my Weight Watchers is back at $38, and for everyone who was worried about the fake price move to 26 because it's not a real stock yet, we're back, and things are looking up. They did a deal with Amazon. I think our partner David has talked about the GLP-1 prices are coming down. They're talking about maybe $150 now a month, $200 a month. Well, that will massively benefit the distributors of those drugs. Now, I'm not as good for the guys who are selling the drug, but you got to expand that TAM. And $1,000 a month, there's only so many people who will pay that. 500 so much. Start getting $150 a month, and it can have massive impact for your life. I think that's an interesting thing. And just one last thing on the Weight Watchers. Speaking of public LBOs, it is a kind of a public LBO. Next summer, they have a term loan that'll be callable. Robert and I, one of our clients, he talks to me about it a lot, his buddy, and he's a high yield manager, and he basically, kind of laid it out, and you're going to get 10 to 12 bucks a share of accretion to equity guys, independent of the growth of the cash flow. So you kind of just like have some of these public LBO situations, as Robert said, where, or an actual LBO where you get paid all up front, which can be very interesting. So that's why I thought about that when you said that. But okay, let's call it. I think that's enough. Good show. And don't sleep on Comstock, basically, is the long story short. Although Robert won't be a buyer. I'm Benjamin Brey. That's Bob Morris, Robert Marcin. This is Wall Street Beats. Come check us out at wallstreetbeats.com, and we will see you tomorrow.
Thank you.